Paul.
Oh no, I don't believe in that sort of thing.
MF Global filing for bankruptcy after the New York Federal Reserve suspended it from working with the Fed at all. We know that it's actually, I was talking to Suraj Sitjo a little earlier, he says he suspects that there was some kind of exposure to European debt. Blame the Europeans.
Damn Europeans. Okay, so MF Global is US based. The most interesting thing about it is that its current CEO is a guy called Giokos, who was previously one of the co-chief executives of Goldman Sachs. Then he left and became the governor of New Jersey, so quite a high-profile guy. Came in as a kind of rock star CEO, but it appears that the firm had a number of problematic business divisions. So it had a banking license, it was providing retail derivative accounts for retail investors, plus it had some hedge fund assets based in London. But the root of the group, the Old Man Group, is like a couple of 100 years old British firm. Anyway, I mean, what
happens that you actually have to file for bankruptcy?
Well,
this must have been bubbling under the surface for quite some time.
I'm simplifying massively here, but remember, anytime you have a firm like that which takes derivative positions, you, the client, have them as your counterparty. They, in turn, have internal and centralized risk management systems to ascertain the extent to which they're exposed to external risks and assets. And in this instance, the firm apparently had a $7 billion position in, I'm about to use the porcine word, but I'm going to refrain from that. They had positions in sovereign debt of peripheral European nations. So they were like long that stuff, imagining that I suppose the European situation wouldn't turn out to be as negative.
And obviously this company must be highly leveraged.
Yes, so it was an old style kind of investment banking balance sheet with many times over gearing. So a big blot on John Corzine's copybook. I only imagine he is going to leave with his name in disgrace and probably go back into politics. That's the only thing he can do at this point.
Capital Shopping Centres out with its interim management statement today, and joining us now on the line is Matthew Roberts, the financial director of the company. Thank you so much, Matthew, for joining us today. Great to have you on the program. We're seeing quite a good, strong occupancy level rate, still sitting at around 97%. You are operating in a very interesting environment where you're seeing the UK retail average vacancy sitting at around 14%, but your vacancy rates are sitting at around 3%. Give us an indication in terms of what is happening on the ground. Are you finding that rental values are far lower than you had anticipated, and you are starting to embark on long-term contracts that are slightly below your expectations?
Okay, good afternoon, and thank you for inviting me on the call. In terms of our performance, yes, we're pleased very much with the 97% occupancy levels that we've got across our 14 centres in the UK. And I think the reason those centres are full is that we own very much some of the top quality shopping centres in the UK, 12 of our centres in the top 35. And from a retailer's point of view, they are must-have locations. So I think obviously the way retailers are using shops today is very different to what they were using them for 10, 20 years ago. And today, for example, with the growth of the internet, retailers want to have much larger shops than they did 10 or 20 years ago, showing their full range of product. And if you can go and look at the internet and see that the whole clothing line, then you want to come to a shop and see it there as well. And again, retailers are using the whole windows in their shops and the whole branding to drive traffic across their multi-channel, the various types of business that they're looking to sell.
It's interesting, Matthew.
So I think,
yeah.
So I think so the retailers are very much looking to come into our centres, and that's why we're full.
Yeah. What's fascinating to note is that the economic environment, especially the retail environment in the UK, we're hearing a very different picture. So, and you're painting a very different picture as well. Are there distressed tenants at this point in time? I know that you have been dealing with some of them, but of the 2,300 units that you have, around only 7 were affected, if I'm not mistaken?
That's correct. So we collect our rent on 4 days a year, and the last one was at the end of September, and we only had 7 tenants that went out of business as of that date. I think that the reality is that although we read about retailers being distressed, actually there have been very few profit warnings from retailers during the course of the last few months. And actually, the reality is the retailers have had 3 good years of trading since the downturn in 2008, and that has allowed them to, rebase their balance sheets, to renegotiate their banking lines, may have had injections from the public market, or if they're private equity owned from the owners of those businesses. So their balance sheet's in much better shape than it was at the time of the last downturn. And again, they've gone and addressed their supply chain issues. So, historically, if you have a bad trading period, what actually costs you is then having to go on sale and shift the product, the clothes or the dresses or the T-shirts that you couldn't sell before. So having addressed the way that they bring the product into their business, they have a much more reactive business model than they had 2 or 3 years ago. And therefore, I think that we believe that the state of the retailers is a lot better than it was in 2008.
Fantastic. That's great news. Thank you so much, Matthew, for joining us. That was Matthew Roberts, the Financial Director at Capital Shopping Centres. Yes, no for you? Buy? Yes?
Yes, look, their customers are doing okay. The business model changed a little bit.
Fantastic. Thank you so much, Paul Theron.